We've talked about Ubiquiti a couple times here on Chipstock Investor. Hopefully, you've gotten in on some of that action.
It's been some good action over the last year and a half since we first did some videos on it.
Let's do a Where Are They Now segment.
Oh man, that is a deep reference to back in the day when people actually watched music videos on cable TV.
That ages us.
It sure does.
We'll also be talking about a small cap company, Arlo, which we've mentioned over on Semi Insider a couple of times. If you want all of our research, check out Semiconductor Insider. We have a new research platform on our website. It has supply chain analysis for the companies that we cover here at Chipstock Investor.
And it's in an easy to read format. So if you're just looking for our research articles written up, that's where you can find all of them. We can't make a video on it all. So see you over at Semi Insider. Link in the description below.
Arlo and Ubiquiti, two tech equipment and device companies, primarily some software as well. And I think we're going to double click on the tech equipment and devices here for just a moment. We'll start with Ubiquiti. And you may remember this from our older CSI semiconductor industry flowchart. But previously, we broke down some of the tech equipment and devices, and this is where Ubiquiti fits in, where all of those pink arrows are. They do a lot of different devices.
They do a lot of enterprise computing devices, especially for small and mid-sized businesses, cloud gateways, Wi-Fi routers, extenders, and then the big segment that does also a newer product entry, I guess we should say, that does things like security cameras, wireless security, and they layer all of that with a unified software platform, which is why we have the presentation today bundled with Arlo Technologies. We'll get into Arlo second, but let's maybe talk about these segments because we thought we should hit on Ubiquiti again for this reason. For the better part of 2 years, they've been reporting sequential revenue growth. And the market finally picked up on that in the last year. Stock ran higher, but then you see the September Q3 2025 quarter, they suddenly reported a sequential decline in sales.
Yeah, 734 million for September quarter. Revenue was up 33% year over year. Net income came in at 214 million and under 200 million for free cash flow. So GAAP earnings per share up 44% year over year, but that free cash flow actually down 16% year over year. So a bit of a deceleration in growth for Ubiquiti. What happened? Is it the North American consumer again?
Less the consumer, more the enterprise. Now, at the end of the day, the year over year comparison is what's really meaningful for the valuation of the business itself. But it does appear that there is at least some sort of cyclical slowdown. Let's do the balance sheet first, because this is pretty good stuff. Remember, we talked about this, the debt that was taken out. We eliminated, for the sake of keeping this chart simple, we eliminated the long-term debt. There is no more long-term debt. It's all been moved to short-term debt coming due. They basically took like a bridge loan out during the bear market, and they've almost completely finished paying that off. So 177 million in cash, only 133 million in debt left over as of September. So by the end of the year, it's very possible Ubiquiti has a completely clean balance sheet once again, with plenty of cash on balance. Also, remember, they did announce that share repurchase program last quarter as well, which management must feel pretty positive about the trajectory of the business over the course of the next couple of years to announce a share repurchase program, we would think. Robert Pera doesn't want to waste money. So yeah, back to the cycle. Here's the inventories for the company. Is this a leading indicator of what's to come for Ubiquiti?
So the inventories, the last time they were even close to this level was back in summer of 2023. But now the inventories are climbing again. So what is this telling us?
Maybe we should mentioning first, this time around, 2 years later, there's more breadth and depth to the product portfolio. So this could be simply just that Ubiquiti has more, it's a bigger business and they have more products, they have more customers. It could be something as simple as that. Versus the elevated inventory in 2023, that was a result of the hardware and the chip shortage of the prior year or two that culminated in the bear market. And then they suddenly had this glut of inventory that they had to work off over the last 2 years. And then 2024, the inventory was probably just too low. They didn't have enough of it. So that's one way to look at this. The other way, of course, is that maybe we are headed for some sort of short-term cyclical slowdown in the business. Inventory is a bit higher. And maybe management thought, when the market gets our financial figures in front of them, the stock is going to come back down. Let's get a share repurchase program fired up and ready to go. It's possible. It's very possible. So it depends. You don't get a lot of commentary with Ubiquiti because they don't do earnings calls.
You get no commentary.
You get no commentary. You don't get any guidance. So you have to do a little bit more digging into, especially the balance sheet, which is why we're calling this out, to try to get a feel for what is happening with the business. They did say that some of their enterprise customer spending did slow down in this recent quarter. And so this could just be, as you said, Casey, the North American consumer and small businesses, I should say more specifically, maybe just feeling the pinch after what's been, I don't know, how would you describe 2025? Dramatic, maybe.
Yeah, maybe dramatic. Tumultuous, maybe. Tumultuous. That's how I would describe 2025.
We've got just trailing valuation here. Remember, because we don't get the guidance, we don't get outlook from management, we're not going to do forward estimates. There's like one Wall Street analyst that predicts what Ubiquiti is going to do, and it's not us. So we're just doing the trailing 12-month PE and price to free cash flow. And yeah, the stock sold off pretty hard after Q3 earnings, but the valuation was pretty high. A lot of heightened expectations baked into that price. The valuation now looks healthier. I still wouldn't call it cheap, would you? I mean, based on historical, this is just a one-year chart, but it's still elevated. The expectations are still high.
Exactly. I would agree.
So if you've been looking at this, take it slow. Don't blow out an entire portfolio position on this in one go. Maybe be a bit patient. Maybe you do something like a short-term DCA over the course of the next 6 months, maybe over the course of the next year, and build a position a bit more gradually and see what's going to happen, what's going to shake out with the company. But anyways, we finally got that sell-off after a really, really crazy 200% trailing 12-month return on the stock. So that's where we're at with Ubiquiti.
And kind of related, let's talk about Arlo. So Arlo makes security cameras and has a software system as well to monitor all those security cameras. Do they make anything else besides that? Home systems primarily and small business systems.
Yeah, that's what they're going after.
Their bread and butter.
Residential and small business. It's a very tiny company. One thing to point out here, Arlo is a spinoff of Netgear a number of years back. But you may be looking at this revenue chart and thinking like this thing has not grown at all over the last 3 years. And by this one metric, by revenue, you'd be right. Very, very little growth. Even on a year-over-year basis in Q3, basically 1% year-over-year revenue growth, 140 million. But do notice that net income, GAAP net income, has just started to turn positive, and free cash flow has also been positive for the last 2.5 years. Let's talk about why that is, because there is an interesting dynamic going on with Arlo. And it's that they've been moving their business model over to this annual recurring revenue model. They want to sell subscriptions because subscriptions make predicting future financials easier to predict the trajectory of the business when you have annual recurring revenue. It's also more profitable. So the company sells the cameras or a package, home security package or a small business package with a camera, a smart lock for the door. and so on. And then if you want cloud storage and other nifty features that go with the app for the hardware, you have to pay the subscription. So that's what they've been moving towards. And actually, that ARR, if you divide it by 4, it implies something like $80 million per quarter, roughly, is what they're doing right now, or nearly 60% of their revenue is now ARR. And as a company makes that migration from one-off sales business model to recurring business model, you do have this effect where the actual top line revenue will appear to be stagnant. We're really under the surface. Maybe there is actually some positive momentum taking place. And you can actually see that filter out when you look at things like the GAAP net income and the free cash flow flipping from negative to positive over the course of the last 2 years. Here's some metrics for judging the new business model. Average revenue per user, the retail long-term value, retail gross margin, 92%. It's a very profitable model they're migrating to. And the retail CAC, or customer acquisition cost, of about $200, the ultimate long-term value of that customer at $750. So as they've kind of made this migration to more ARR over the last 2 years, this is where they've turned profitable. And so now I guess, Casey, the question is this not just a sustainable, profitable model, but can they actually generate some actual revenue growth? Similar to what we just got from Ubiquiti, it looks like we are stuck in some sort of mid-cycle cool-off. Revenue guide implies not a huge, but roughly 3% sequential decrease in sales at the low end anyways. Company is going to remain profitable, so at least there's that.
But this especially makes sense with a company like Arlo that's especially for the retailer, the consumer. It makes sense that they're going to have a slowdown. There's a lot of pressure on the North American consumer, especially. Installing cameras is probably not as high on the priority list as some other needs, obviously. So let's take a look at their valuation and explain this wild chart, Nick.
So remember the GAAP net income flipping from negative to positive in the last 2 quarters, 3 quarters. That's why the trailing PE ratio, which we have in red, looks absurd. But the forward ratio is at 20x, 21x expected earnings. I think that's probably on an adjusted basis because that's kind of how Wall Street analysts will project those earnings per share figures. But at any rate, you can see the positive momentum Arlo has going for them, even if there is a cyclical cool off in consumer spending and small business spending as we close out the year and enter 2026. Perhaps you may look at this metric and think, if Arlo can deliver on this new business model, ARR heavy business model, that's much more profitable than just one-off sales of cameras, maybe this is a small cap business that you want to keep closer tabs on. And I guess that's a hint. I guess this is one that we're kind of interested in keeping tabs on. We're not buying yet, I think, for the same reasons as Ubiquiti. We're kind of interested in seeing the Q4 report, initial guidance for 2026. We want to see what that pressured North American consumer actually translates to for these companies' financials. And then we'll make a decision from there.